welcome to episode 2 of the new ERM Advantage podcast. I'm Eric Holmquist, and today's will be the last episode for a while. I'll be doing by myself. Going forward, I'm going to have a whole series of really interesting guests coming in that I'm very, very excited about. But I wanted to finish off part 2. In part 1, I sort of talked about some thoughts and observations on the state of the industry, particularly financial services. And in this episode, I want to talk about kind of the state of risk management as I see it. Now, again, this is going to lean a little heavily towards financial services only because I'm just most familiar with the industry. But when we talk about risk management now, we're really talking about a general management concept. So all of this really should apply to any industry. Doesn't matter what you do or make. Really, the only difference is just level setting where your company, your industry is at relative to some of the observations I'm going to share about financial services, which has some work to do. So basic outline for the discussion today, I'm going to kind of talk about just some general broad state of things thoughts. And then I'm going to talk a little bit about sort of speaking to leadership, speaking to practitioners, and hopefully bring some practical observations, speaking a little bit to advisors in the field, such as myself, a little bit speaking to regulators, and I'll hit a couple of topical areas as I did in the last episode, things like AI and GRC, but really just in the context of how we see those things influencing risk management as opposed to the industry. And then closing with a little bit of sort of future state and ideally kind of what I'd like to see in that future state. Quick sort of disclaimer, because obviously a lot of this will relate to content that I've developed. I will periodically mention on certain topics that there's a related video you can go see. Of course, those are all available for free on my channel. But I've also got some tools and templates that are available, and I will just mention them in passing. I'm not going to spend time on them, but if you'll just indulge me, I at least want to make people aware when I'm talking about different topics, if I have tools that are available so that people are aware they can go look at those. So, all right, let's jump in. All right, so despite the fact that risk management as a discipline has been around for a long time, we've been doing this a long time, and really developed as a discipline with some structure around it for some time, to be blunt, I continue to be somewhat underwhelmed with where we're at. Now, again, I think this is going to be different by industry, different by company. And again, if you'll indulge me, I'm going to be kind of blunt in this session. And I think it's most productive because if I'm blunt and kind of lay out, I call them as I see them, it gives me an opportunity to kind of talk about where I think we can improve and strengthen and why I think that's important. It's very interesting. I've had the opportunity to listen to head of risk with the Nuclear Regulatory Commission, the head of risk with NASA, the head of risk with an energy company, and it's really interesting because in those interesting industries, risk management means something different. In short, you don't manage risk, people can die. And that is notably different than what I typically deal with in financial services, where the downside is usually framed in terms of we could lose money. So it's very interesting when we put the conversation in the context of people could die. Well, suddenly things take on a kind of a different complexion. Now, the good news there is that those industries take risk management really seriously, and they really do a very thorough job of understanding those scenarios where somebody could get hurt, things could be damaged, etc. The downside is that, and I've had this echo of the people I've talked to in these industries, is they tend to focus on just the people could die stuff. And so I've seen companies that are now trying to build a more fulsome enterprise risk management program where they consider some of the more routine kind of day-to-day risks. And that's good. It's a little different in financial services. And I think it would be fair to say that, because, what we define as worst case scenario really is more of a dollars and cents conversation. I think it has allowed for developing programs that, in some cases, I think are just kind of mediocre. I don't think they're focusing on the right things because again, we're sort of making it up as we go. And I'll break this all down and I think rationalize that. But, the bottom line is I think that it's time for an honest evaluation of kind of where we stand and sort of where we go here and why it matters. So focusing on enterprise and operational risk programs, again, principally in more of the kind of the white collar space, I've seen them typically grounded in some misguided principles and often with kind of an audit mindset around an emphasis on operational risks and the controls, when the reality is that it is almost always more of the design risks, things related to your strategy, major programs, et cetera, that could really be life-ending. And if you look at the failures, that's tend to be where they came from, is some of the flawed assumptions in the design of some things. So I've talked at some length about how programs have to simply go beyond that. But this is one of the fundamental problems, again, grounded in some faulty principles. I want to read in the very first video series I did a series called Are We Doing This All Wrong?, where I laid out what I think are some notable concerns I had related to a lot of common risk management programs and practices. And I just want to read those real quick because, again, they're foundational to a lot of what I'm going to talk about, but I think a lot of these still very much hold. In terms of observations of problems within programs I see, and that typically lead to underperforming programs that don't deliver the return on investment, the results that management would like. Number one, the language of risk instead of the language of the business. And I talk a lot about trying to get programs back into the native language of the business instead of a lot of confusing risk jargon that nobody understands. Programs built around risk types, I've talked ad nauseum about this, that one of the worst things that ever happened was creating program frameworks that would divide everything up into risk types and then try and manage it all from there, and that will never work, and it will always lead to underperforming programs. A lack of clear standards within the program, different methodologies used, unnecessary complexity. We just like to overcomplicate what in the end sometimes is really pretty simple. Risk appetite, ambiguity of not real clarity around risk appetite, consistently poor understanding of metrics, disconnected programs. I've got risk management happening in different areas and they don't even look like each other. A lack of framework maturity and a lack of cultural transparency, which is where it all has to start. So the points I talked about in that series was, what needs to happen is, number one, changing the language. Again, just getting back to the language of the business wherever possible, the language that the business uses and can understand. And that plays out in all of my videos and all of my tools throughout. Simplify things whenever possible. Changing core dimensions, getting away from risk types as root dimensions, which again, never works, to the three core dimensions of design, strategy, external influences, and operations. Getting frameworks technically correct, grounding the frameworks in their assumptions, prioritizing both the process and the conclusions, the so what's, more balanced risk assessments. I'll talk about that. Program alignment. So again, I'm doing things in similar ways with similar methods. Embedded and integrated ERM. It's not something we staple onto our world. It's something that's just woven into the fabric of who we are. And promoting ownership. I want to build a big army. I want people thinking like risk managers. So to the extent the program can help do that, I'm going to have a better program. So again, going back to the question that I asked in the first video, and this is the central litmus test question. And you look at the sum total of your risk management program and all of its component parts. Is it helping you make better business decisions? It's a really simple question. But it goes straight to the heart of, are we doing it right? And if the honest answer is, well, no, you're not there. There's work to be done. The goal of the program is to help management do business better, to make a better business. If you would characterize your program as any one of the following, there's something wrong. Number one, it's mainly just documenting what we already know. We don't really learn anything, but we're documenting what we do and particularly like controls, things like that. It's primarily focused on control identification and testing. Or three, it's just a lot of busy work but rarely any new knowledge is gained. It doesn't really create any value. If any or all of those might characterize how you would say what your program is, you're wasting a lot of time. And that's okay, because again, you've built some foundation. You've at least implemented some pieces that make people aware that we need to think about risk management, but there's probably some room for improving and enhancing in a way that can create less busy work and more value in the process. So that's a lot of what we're going to talk about. Those aren't ERM. Those are barely ORM. Enterprise risk management, at the end of the day, is so much more about why we're doing the things we're doing than how we're doing it. The how is important, but why we're doing something is often where the really significant risks tend to live. And our programs, at minimum, need to get way, way better at helping us understand why we're doing what we're doing. Some of the, again, fundamental flaws, just to reiterate these as foundation for the rest of what we're going to talk about today, is some of the biggest mistakes I see and sort of misguided priorities for programs is, number one is, you start a program and your first sort of efforts around better control identification. Sometimes we don't know what to do. We don't know where to start. So let's start there. No, all you're doing is you're creating internal audit 2. We don't need internal audit 2. Risk management is not about getting better at defining controls. That's control management. Risk management is about getting better at understanding why we're doing what we're doing and what are the risk profiles that we create in doing that. By being in a certain business, we establish a risk profile. We mitigate some of that risk, and we're left with some sort of a residual profile. That's the risk we accept and we live with. Understanding those, the risk of the business we're in and the risks we accept in that business, is the principal focus of a strong enterprise risk management program. So that's why we have to ask that. The other thing I sometimes see is programs where they say, well, we're gonna start with some metrics and that way we have something we can produce. No, please God, no. That is not where to start. Metrics are an outcome of a whole lot of foundational elements, not the least of which is understanding risk appetite, understanding your risk assessments to understand where your key risks are. And only then could we really understand what is the right things we should be monitoring. Otherwise, if you just produce something, you're not going to create value. People are going to get frustrated, and the program is going to lose credibility because, again, you're not basing it on any foundational objective truth. Programs, again, are sometimes too over-focused on the operational risks, the processes. What's the process? What's the control? All that. Because people get that. I get it. I understand it. People can wrap their head around what's the process, what could go wrong, what are the controls. It's a linear thought process. It aligns with the audit program, and people can conceptualize that. But again, it's not where the big risks live. It's important to do, but that's not where to focus. If I was starting from scratch, that's not where I would start at all. If I was going to start from scratch, it was nothing. I would start from what's our strategy and what's the risk that's inherent in our strategy. And from there, I would start talking about some of my more governing programs that we'll talk about in a little bit. And I'm not saying looking at operational risk is wrong. We need to do that. That's important. But if you're going to ground a program, you're going to focus initial efforts. It's not the place to start. It may be the most familiar place, but it's not going to yield the best information. So the program needs to be able to support an honest evaluation of, again, why we're doing what we're doing. So what does that mean? That means understanding the risks associated with our strategy. Our strategy has risks, not the least of which is, what if it's a bad strategy? And then there's a whole lot of what could go wrong with it and what if it's a bad design and all that. Understanding the risks of certain key areas of design, how we manage things like liquidity, interest rate risk, capital, things like that. Again, there's a how we do it. But if where risk management starts is how I do it, which is, do I check the right things and have the right limits and all of that, I've completely skipped over the first part, which is what's the risk profile we're trying to design to. Liquidity is not an absolute. levels. Some people want to have abundant and ample liquidity. Some people are more comfortable keeping a little bit thinner so they can invest every penny they have. Those are risk philosophies. And we have to start there. What's the philosophy of our risk appetite and the profile we're trying to work towards? Then we can talk about the mechanics of how we manage those things. We have to understand the strength of our governing programs. The programs that relate to all the areas of risk, whether it's enterprise risk, even internal audit, information security, IT risk, third-party risk. These are all governing programs that represent key and significant areas of risk, and we need to be able to periodically look at those programs and say, are these good programs, or could they be improved? And gosh, the number of times I've been talking with a client, and they would just flat out say, yeah, it's not good. it's not a good program, but we don't have time to fix it. Well, I don't know. A wise person a long time ago said it's always easier to do it right the first time than have to clean up the mess from not doing it right. I think that's pretty sage advice. And finally, really understanding the risks of change and how we manage, change and when we implement change, new initiatives, new products, new divisions, new, industries, new regions, all the way up through acquisitions. Every one of those pieces of change introduces risk. I've said it for many, many times. The seeds of risk are always sown in change. If we look back at great failures in history, we can often trace those failures back to something changed. And that change now introduced a level of risk that we hadn't really thought about. So again, those are some of the areas that if we're going to, again, kind of benchmark our program, those are good areas to think about benchmarking against. Okay, so enough of that. Enough bad mouthing. I promise you, I want to get to some very practical suggestions and things to think about how we can improve this and how we can strengthen our programs and move to them creating more value. All right, let's start with some thoughts for the board and senior leadership. And again, I'm just going to be kind of direct because I think it's important just to be able to have an honest conversation. And again, it's my show. But again, I think there's just some points that are very important and can be very influential in terms of the success and strength of a program. We all know, you've said, tone at the top is important. Yes, it absolutely is. But it's more than just tone. It's not just tone. You have to believe this stuff really matters. You have to believe it in your bones. And show in word and deed that this stuff matters. If what risk management is just creating enough window dressing that regulators leave you alone, turn this off. You're wasting time. There's nothing I can tell you that will help you. This is for people that really want a program that, again, is meaningful to the business and creates value for them. So number one, you need to be committed to the 3 lines model, supporting that the first line owns the risk. Second line does not own the risk. Second line is responsible for the architecting of a risk management framework that allows management to help understand and manage their risks and to provide an effective challenge. And sometimes they're a subject matter expert, and that's great, but at the end of the day, it's first line owns the risk. And if you're not supporting that message, if there's any shred of blaming risk for something, you're killing your program and you're kneecapping your risk team because, again, management has to own the risk and the implications of their decisions. Second line is responsible for building tools, and if they're not building tools, that's a problem. We need to think about, do you have the right people in those roles that can really help build tools for management and serve as that effective challenge? And then obviously third line is audit, provides attestation and review. Be thoughtful about when and or if you hire a CRO. I've seen institutions and companies that just felt like, well, we should have one. Already we got a problem. No. You shouldn't. I mean, I've seen some fairly sizable organizations that don't have one, and they do just fine. The reality is that you can accomplish a lot of the same thing by using like a risk management committee as oversight, supplemented with some external subject matter expert resources on building your program. I think there are some thresholds around when a CRO does make sense. I'm not going to go down there because that's a long conversation, and I will be doing a video fairly soon, a training video on the 3 lines, and I'm going to go deep onto role the CRO. But if you feel it is time And oftentimes it's, once the program is starting to get kind of leggy, a lot of moving parts, and perhaps it's starting to get more complicated, then yeah, it probably makes sense. You want somebody that can be, the captain of the program and can really kind of be the evangelist for risk and risk management. And then you help coordinate resources. But when you look for a CRO, you need to look for somebody that not only has experience, obviously they need to understand your business and all of that, but they need to have a great deal of emotional intelligence. It is the single most important attribute to look for in a CRO. They need to be able to interact with management. And to the CROs out there, I would challenge you to lead by influence, not by authority. You may have some authority, but never use it. You will have been successful if you never had to sort of, call rank in your term as CRO. Lead by influence. It's a way, way better model. And you're not the chief know officer, N-O. I say, be the chief know officer, K-N-O-W, helping people understand things better. But when you're looking for the CRO, you need to find somebody that has really strong emotional intelligence, communicates well, relates well, from the basement to the boardroom. And then they need a seat at the table. This is not an audit person. This is not a controls person. If you're hiring or promoting somebody because they can help test controls, you've already lost. That's not the job. You need somebody that has a seat at the table, can help think strategically, can challenge strategy, can help architect a program, can stand with management, with leadership, and ask hard questions, be that voice of challenge. They need to be part of your senior leadership team. If you don't have that, then it may be time to rethink who that person is. The ideal reporting structure is reporting to the board risk committee with a dotted administrative line to the CEO. And he should have periodic executive session with the board. This is a person that it's a part of senior leadership, and he is independent in the same way that head of internal audit is. And they should have an executive session periodically to be able to chat with you openly and honestly and give you observations, hear your concerns, and be able to have an open dialogue. Again, they must be able to talk to management and ask hard questions, be kind of the corporate conscience in a way. And they need to be able, again, to relate. They're helping management by virtue of building the program and creating tools, but again, also kind of be a subject matter expert, bring some perspective, help ask questions, but it needs to be done as a peer, not as an operational person. So there's a lot there, and again, I'm going to unpack all of that in the video. On my website as well, there's also an article in the resources section on hiring a CRO, and it's an article I wrote a few years back that's been highly, highly requested many times. That just talks about the thought process around hiring a CRO and what you should be looking for, some of the questions you should be asking to be able to focus your efforts to hire a CRO. And again, that's available for free on ERMadvantage.com in the resources tab. Okay, let's pivot a little bit. We've beat up on the leadership team enough. Let's talk a little bit about the practitioners, our CROs, our risk people. You folks in the trenches trying to build the program and underappreciated and underpaid and overworked and all those good things. But hey, you're doing God's work, so keep it up. But I do want to, again, have a little conversation here, a little tough love, but also try and give some practical suggestions. Because again, I've looked at a lot of programs. I've helped a lot of programs. I've spent more time than I care to admit thinking about this stuff. And talk with a lot of colleagues and peers, and I think I've got kind of a sense as to what some best practices are, and that's kind of what I want to talk about today. Look, if you know your program is falling short, it's not where it should be. Don't struggle with this for years on end. I think one of the biggest sort of frustrations I've seen is that, well, we're gonna build this little slice this year, and next year we're gonna build this. Why? This is not that hard. You can build a program in a year. I don't care how big the organization is. Less than that. Get some resources and talk to some folks about how to build a program. One of the videos I will be coming out with that I'm actually kind of excited about is kind of designed towards new CROs. Say you just took the job and you get in and realize, oh my God, there's nothing here. Nothing's right. Nothing's built. And so where do you start? And so I'm going to orient this particular video around how would I approach it if there was nothing there? And what I'm going to do is I'm going to look at every element of the program: policy, governance, risk appetite, risk assessments, metrics, all the building blocks, and say, okay, what would a minimum viable product look like? Because you can't spend a year building one piece while the others suffer. And so this is going to be some suggestions on how to sort of diagnose where you're at. Give yourself kind of a maturity rating. Think about where to focus, where to prioritize, and again, what a minimum viable product might look like for those components that you could then build and improve over time. And I've had some interest in this, and I feel the pain. If you've got 10 different fronts you're fighting, you need to be able to kind of pick your battles. So first, governance. Just broadly on governance. Obviously, same I said to the board is respect the 3 lines. You're the second line. You don't own the risk. You are there to provide a challenge, an effective challenge. And it's one of the reasons that I'm not a fan at all of CROs having approval authority. It's a bad idea. You've got a product or an initiative or something major, and the senior leadership all signs off and you are an approver. Bad idea. Should not happen. And the reason is because the second line, by definition, is not accepting the risk. You are there as part of the risk program. But if you are approving something, you are accepting the risk. If anything you would approve, it would be that the process was followed. I think the CRO should not have approval authority. The CRO should also not have a denial authority, a veto authority, because again, you're making a risk decision. This is why it's much, much better to lead by influence. Perfectly fine to say, I don't think we should do that, but it's leadership's call, and just document that your view is X. But again, I think it's very important you respect the lines. If first line's going to own the risk, they have to own the process in establishing risk. Policy, obviously you want strong policy, but just quickly on this, the model I really, really like that has worked incredibly well is I've seen risk policies all the way from one sheet of paper, worthless, to 50 sheets of paper, also worthless. I got everything but the kitchen sink in there. Neither of those are workable models. Instead, what I am a fan of is having a policy that is fairly trim, that really establishes kind of the program standards and expectations. In other words, really is the voice of the board. It is the voice of the board saying, here is what we expect. Again, this doesn't have to get into excruciating detail because all it's doing is laying out what is expected of the program and the purpose of the program. Then having a program document that is really the voice of management that basically says, we heard you, and this is what we are doing to be able to achieve the expectations of the policy, and start to break down some of our program elements, get in some more of our standards, things like that, and lay out what is the risk framework for the company. And again, what's really strong about this is it keeps them at the appropriate elevation. The policy remains the voice of the board. The program remains the voice of management. Consequently, policy is approved by the board, once a year unless something major changes, but the program would change any time. It's not approved by the board, it's just received by the board because it's management's voice, it's their story. So we want to change the program, and then just document it accordingly. And then policies in general. I've talked with so many companies that, how's your policy program? And they just roll their eyes. Yeah, that's not good. We inconsistent standards, and everyone looks different, and it's like, how many years are we going to have this conversation? I mean, seriously. So look, all I will say is, and this is the parents kind of clean your room sort of thing. Yeah. I am a big fan of having kind of a governing documents policy, and this is a grown-up version of the old policy on policies. It's the idea of governing documents, meaning this document can describe what a policy should look like, a procedure should look like, our charter should look like. We have all these governing documents, and it's a good idea to establish a standard for this is what they should look like, this is what they should contain. And it is really a good housekeeping element to be able to have something that defines the standards for these governing documents. And then, look, I know this is the 75th thing on your to-do list, but look, just get a couple of people, either hire some contractors or have some people and just go through your policies and just get them trued up. Get your charters trued up. Again, I know it's the last thing you have time for, but it really is good housekeeping, and you'll be glad you did in the end. And Just make it a project. It'll be fun. We'll all live to tell about it. And then finally, risk committees. Not a fan of committees in general. In fact, I loathe committees. How many of us have been sitting in committees and we're thinking, please God, kill me? We all have, because they tend to be designed wrong. I do, however, love risk committees. And the reason I like risk committees, both at a management and a board level, is because they're the one committee that is designed to be forward-looking. They are chartered to ask, what are we doing, where are we going, and how do we feel about it? And that is a good thing. But the rub is they have to be forward-looking. And if your risk committee is an hour and a half of talking about stuff you've already done and you already knew about, you are wasting people's time. Just stop. Look at your agenda, look at your artifacts, look at the discussion points, and how much of that is not where you've been, but where you're going. And if less than 50, 60, even 70% of it is not forward-looking, you've got work to do. Having reports that talked about what happened is fine. That's all preamble to things you're going to discuss. But the conversation really focuses on where are we going and how do we feel about it. And to really challenge yourself to say, how can I make my conversation, my information, my decisions more forward-looking? Now, I'm a big fan of a distinction between an enterprise risk committee and an operational risk committee, and this is a management level. And what I mean by that, that's not an inconsequential distinction. What I mean by that, and I think the structure that works really well, is having an ERM committee or management risk committee or whatever you call it, that is senior management. And one of the biggest mistakes that people make is they put every living person on this committee with the idea that, well, it's a good way to keep people informed. No, wrong, bad. We don't do that. We don't invite everybody to the board meeting. No, you want your senior leadership in there so you can talk about senior things. And a lot of that is going to be, some decisioning around, new initiatives, change, whatever, but also understanding some of your risk profiles. Then I like the idea of having an operational risk committee, which is where we get into more of the weeds of what we're doing and how we're doing it and how's it going and that sort of thing. And that's a body that makes a lot more sense to have a much more broader set of stakeholders, because there's a lot of people that have influence or participation in operations in some way. And that, I think, is a body where you could really sort of get into some of the, the day-to-day, nuts and bolts. That structure works well. What I would be careful with, and this is particularly true of the ERM or Senior Management Committee, is approvals. And this is kind of a technical distinction. It's a little splitting hairs, but I think it's an important distinction. It goes back to what I said about the CRO not being an approver or a vetoer. The risk committee works kind of the same way. It's not fully independent because it's not second line. Obviously, a lot of first line people involved with it. The problem is that it works really well as a governing committee. And so all the other sort of risk things, reports from other committees, other risk assessments, sort of rolls up. This becomes the funnel that things sort of roll through before they go to the board. That's a good thing. The challenge is that it's hard to be a governing body overseeing what we're doing and how we feel about it, but also being an approving body. I'm not saying you can't do it. There's no rule saying you can't. If you want to have major new initiatives come through that body and have them approve it, that's fine. You can do that. Just realize that that has one, challenge, and that, again, are we having our challenge oversight corporate conscious hat, or are we having our yes, we should do this kind of hat? My ideal model is that there is a kind of a change committee of some kind or a management committee that they are specifically chartered with approving things we're going to do. And that keeps a risk committee's powder super dry, because then they can stay true to a charter of overseeing what we're doing and saying, are we staying within the guardrails of our strategy and our risk appetite? Again, no right, no wrong. I'm just saying, just be careful with how you assign approval authorities. And then you can use these bodies to really look at the overall risk profile, but also, again, as your sort of funnel as information is going to the board. And then finally, from a governing standpoint, just, again, take an honest look at your key programs, your risk program, your compliance program, third-party, InfoSec, and be willing to honestly kick the tires on these and say, are they operating as efficiently as possible? And are they focused on understanding our risks, not just testing our controls? That's really what the distinction as to whether they're control programs or management programs. Okay, now we'll start to get into some of the blocking and tackling elements, starting with risk appetite. Risk appetite framework is a critical part of your overall risk management program. And again, one of the challenges that I have seen is frameworks that are built on a combination of these ambiguous, amorphous, subjective appetite statements. We have a low appetite for X, that nobody really knows what that means, combined with some metrics that don't mean anything. We'll talk about that. This to me is really a frustration because this is one of the most important governing elements of our risk management program. It is foundational to everything we do, from setting strategy to evaluating our operations, and it has to mean something. So I have a video on this, so you can go look at it, and it talks about risk appetite. One of the central principles in that video is this idea of building some objective support for our risk appetite statements. In addition to the video, here's the first pitch. I'll be fast. I also have available the worksheets that I describe in that video that are management worksheets that take risk factors in English, in business language, and work with leadership to evaluate these business factors based on decisions, and those provide objective support for our risk philosophy. That's one of the key elements here, is building more objective support to our risk statements, our risk philosophy. So when we say we have a low appetite, we know what that means. I can peel that apart and show you what that means in business English, of what low means, and that I can evaluate in my risk assessments and my monitoring later on. The program needs to be able to influence decision-making, not just be window dressing. Hey, we built a risk appetite statement. Yeah, staple it to the wall and frame it. No, you're wasting time. These need to influence decisions. I'm going to give an example from some years ago. I had a client, great little client, neat little bank, just really neat people. And they were really trying to sincerely, even though they were a fairly small bank, they were trying to build a legitimate risk framework to help govern what they're doing, but also really help them to grow and grow in a safe, responsible way. So we knocked together a risk appetite framework, and everybody agreed with it. And one of the tricky elements when you're a small institution is, sometimes people have three hats, and so sort of who's doing what can get kind of tricky. And sometimes you have to, particularly when it comes to like the operational risks, you have to kind of pick your battles. And when you write an operational risk appetite statement, it's going to be some form of stuff's going to break. Okay. We can't be everywhere all the time, but we're going to mitigate the really big stuff. But along the way, we're going to stub our toe here and there, and that's okay. So that was great. They understood that, and we established statements that was something along the lines that we don't want an excessive amount of risk, but we accept the fact that we're going to have some stubbing of our toe here and there. So the ink was barely dry on this, and something bubbled up that people, I could tell, were in a frenzy about. And the issue was that they're a smaller bank, and so they tend to originate a lot of their loans, including some consumer loans, through these loan brokers. And one of the brokers brought them a consumer loan, and he had used the wrong form. This was back when TRID had just been updated, and everybody was kind of insane about this. And using the wrong form is kind of a big deal. This could be a problem. So everybody was just going nuts, and all of a sudden the conversation instinctively goes to, we need a checker. Oh God! And I said, okay, hang on, stop the train. Okay, before we go creating more process and adding more friction to what is a relatively straightforward process, let me ask you a few questions. And I said, how often has this happened in the history with this broker? And I said, first time it's happened in 10 years. Okay. What was the net effect? We redid the form. You redid the form. Okay. Didn't make the 6 o'clock news. Best you can tell, it was the only instance. They probably refunded the customer's application fee or something like that. The impact was absolutely negligible. And because there was no evidence of a pattern of it, that's something the regulator's ever going to get in a twist over. I said, why in God's name would you add a part of a process to something that you know the risk and the impact is negligible? So I said, here's what you're going to do. We'd recently done a full operational risk assessment, so we had all their processes documented in business units. We said in that business unit that does these, we're going to note one of the risks we are aware of is the broker that originates the loan could use the wrong form and we might not catch it. If it happens, we'll fix it. And they went, can we do that? That's the whole point of all of this, is being able to, as a business, say, we understand the risk, we understand the implications of that risk, and if it goes wrong, we'll write the check. But we're not going to spend money on a control when the cost of the control is more than the cost of the risk. Now, audit wasn't happy about this. Oh, well, it's not their decision. It's management's decision. And here's a good example, a practical example of where having a clear understanding of your appetite and a clear understanding of your risk assessments lets you make better business decisions, because we could say, no, we're not going to add a checker. Again, if it goes wrong, we'll write the check. This is a completely different thought process, but this is when risk management starts to make it different. It starts to be a management tool instead of a documentation tool. And finally, in terms of just operationalizing this, and again, I get into this a bit in the risk appetite video, is, when we establish these lofty statements, we have a low appetite for X risk, I can objectively support those, but we still have to ask ourselves, how do I make that meaningful into the business? And in short, the way that's done is largely through our metrics we use to track what's happening, and then the limits we establish. That's how we can dial in risk appetite, because the limits and how far is yellow, orange, red before something has to be done, that's the most direct way that we can operationalize our appetite, as well as how we look at our risk assessments and, again, dial in what we think is the right amount of risk we want to take. But again, that's a deep rabbit hole I want to get into, but I do get into that quite a bit in both the risk appetite video, the risk assessment series of videos, as well as the metric videos. All right, once again, we're going to take a 60-second break for a quick commercial message. We will be right back.
One of the most important questions you can ask about your enterprise risk management program is it helping you make better business decisions? Or is it simply taking up a lot of people's time without creating any value? Is it helping you gain a better understanding of your business? Or merely documenting what you already know? The tools and resources available from ERM Advantage are built specifically to help any organization get the most out of their risk management programs. We have the largest library of free content covering proven best practices in enterprise and operational risk management. We have developed industry-leading tools and templates for every aspect of the program, including risk appetite, risk assessments, risk monitoring and reporting, and so much more. All available at a fraction of the cost of developing these tools from scratch. We are ready to assist you with program development or enhancements, board or leadership training, or reviews of existing programs. Contact us today to see what best-of-breed risk management can look like in your organization.
Welcome back. Today we are talking about risk management and kind of the state of risk management as I see it. We just talked about risk appetite, and again, just to put it bluntly, I think this is an area where there is a lot of room for improvement. Again, most of what I've seen is kind of just documentation, but it's not really influencing decisions. So a lot of work to do there. Then risk assessments is the logical next spot. Again, I've got a painfully long series on YouTube on my channel on this, where I go into just an excruciating level of detail on risk assessments. And I am actually going to do another one that is kind of, give me the Reader's Digest version for folks that I kind of give you the high level. But again, I wanted to really give practitioners something they can use that's really practical. But as I said in that video series, risk assessments are a lot like mirrors. Mirrors can be used for one of two things. They can be used for discovery or for confirmation. When I look in the mirror, I can look in the mirror to say, is anything wrong? Is anything out of place? Or I can look at the mirror to admire how gorgeous I am, which that doesn't happen. It's really up to you. And how you approach these is really determined. Do you want to discover Or do you want to just be able to show you have good controls and document that? If all you want is documentation, that's fine. You can do that, but you're never going to get any value out of the exercise. The only way you're going to ever get value is if you're willing to say, we want to discover, we want to find out what we don't know that we should know. Now, again, this is where the key is really the correct foundation. I don't want to spend a lot of time on this. I've said before that the worst thing that the industry ever did was deciding to ground programs in risk types. And I cringe every time I see organizations that have risk assessments that are all organized by risk type. What are my compliance risks and my reputation risks and my liquidity risks and my strategic risks? No. That's not how the business works. We've got to get a correct foundation. This is central to this framework that I built, the tools that I offer, the videos I use, where I talk about we've got to flip the script on this and abandon using risk types. They're perfect for setting risk appetite. People can wrap their head around the level of credit risk we want to take. But it was a disaster that we ever used them as a way to assess, because it doesn't work that way. No type of event is one type of risk. So the whole way the framework I established was, is this a design issue around strategy, governance, etc.? Is this an external influence, economy, regulators, competition? Or is this execution, my process, my operations? Once I ask that and consider a scenario within one of those three buckets, then I'm perfectly free to say, when I think about the possible impact of that event, that scenario, then I can say, is that a strategic aspect? Does it have an aspect of strategic risk, compliance risk, reputation? I can consider any type of risk. I end up with a much better assessment and much better conclusions around the risk types, because I consider a risk type impact from any risk. So number one, establishing correct foundation. And again, I've got a ton of tools on this. This is the one element within the ERM Advantage framework that could be radically different from how you do things, but it's worth making the change. Trust me. Because once you make this change, you will simplify things so much. Management will appreciate it because they say, oh my God, this makes so much more sense. Next, consistency across all assessments. I can't have one assessment uses one methodology, one uses another. So we've got to get better at making sure we're using consistent approaches across all our assessments. And again, when I'm doing an enterprise and operational risk assessment, the goal should be understanding my risk profile. What's the risk we are taking, both inherently and residually, not control identification. That's not the purpose of those. That can be done. But the value is understanding the risks we're taking and being able to say, is that right? Is that what we want it to be? There has to be a so what from them. If there's no so what, then there's work to be done. There has to be some takeaway. If I finish an assessment, didn't learn anything from it, I probably didn't dig deep enough. And again, kind of a litmus test question when it comes to assessments is, does it ever lead you to a conclusion of something that you shouldn't do because the risk is just too much or we can't mitigate it? We need to be able to ask ourselves hard questions and really look honestly at, are our assessments actually yielding new information? If not, let's improve them. Yeah, let's strengthen them. Let's see what we can do. And the next is metrics and then reporting. Again, metrics, the last series I did was a 3-part series on metrics, KRIs, KPIs, KCIs, etc. And again, I don't want to repeat all that. But what I will say is that, again, I've talked to a lot of organizations and I'm consistently underwhelmed by how companies approach metrics. Again, the things I see consistently is, we're reporting on a lot of stuff, but it doesn't really mean much. Just because something can be tracked doesn't mean it should be. The thing with metrics, and again, I lay this all out in that video series, is the key with metrics is not can I measure it. The key with a metric is how closely it correlates to an actual risk. In simple terms, for any given metric, if it's in the red, does it mean that something has broken and badly? Or does it mean something could break. So if red means it's broken, okay, we've gone off the edge. Okay, that's probably a decent metric, because what that's saying is that correlates very highly with the event, the metric to an actual risk. If it's not on fire, but it's really close to it or has a very, very high potential, that's probably still a good metric, probably correlates highly. But if I have to honestly say, honestly, it could be in the red and it would be nothing more than we should think about it, that's not a good metric. It doesn't belong on a primary dashboard. It belongs in a report somewhere. That's a trend we should pay attention to. And we have to be able to be critical in looking at the metrics we're using and saying, how do these correlate to an actual risk? And the template that I offer around metrics and reporting is very, very grounded in this, about talking about the correlation of these metrics to risk. And if they don't correlate highly, they don't make sense in a dashboard. It's really as simple as that. And again, there can be levels of metrics. It could be a primary dashboard, that's the stuff that matters. It could be a secondary dashboard that is more interesting, informative, but it's stuff that's just more anecdotal. We're not managing to it. And if it's beyond that, just put it in a report. I can read as part of a body. But we've got to be able to be critical in evaluating what metrics make sense. We also need to be able to establish very clear limits. And I like the model of yellow, orange, red, which loosely translates to, watch it, think about it, do something about it. That I find works pretty well, and have a very clearly established thresholds around what is the limit for this metric, around when I should just kind of keep an eye on it versus I should, have some discussions, some decisions around it, versus red, which is we got to do something and document what it is we should do. And finally, we've got to get our head wrapped around the idea that the state of the metric is not the state of the risk. And it drives me nuts when I see, dashboards that shows the yellow, orange, red. It says low risk, medium risk, high risk. It doesn't work that way. It's never worked that way. Again, the anecdotal point is, if my heart rate is elevated, does it mean I'm working out or does it mean I'm dying? Just because a metric is elevated doesn't mean the risk is. So we need to distinguish in our dashboards saying this is yellow or it's orange. That's just the state of the metric. It doesn't mean anything until I interpret it. These are proverbial smoke alarms. If the smoke alarm goes off, it doesn't mean there's fire. It just means there's smoke. We have to look and see if there is in fact a fire. Is there a fire, or does it mean I'm cooking again? It's all in the interpretation. So separate the idea of the state of the metric from the state of the risk. Again, that's a couple of quick thoughts, and we'll come back to metrics and reporting later on in other episodes, because I've got some folks I want to kick this around with. But it's an area where I continue to see programs underperforming because people don't understand the purpose of metrics. And related for reporting, obviously some of that will be your metrics, but also some of it is just narratives around what we're doing and what's going on, that sort of thing. And really, again, the question here is, when I look at the reports that we're running up through committees, through management, through the board, every report should tell us something about where we are relative to the guardrails. Again, strategy and risk appetite. Are we in line with those? Is the stuff we're doing still in line with our strategy, or are we veering from that? Is it still aligned with our risk appetite, or are we veering from that? Where are we going, and how do we feel about it? Again, this creates a conversation that is forward-looking, not just documenting what we've already done, saying, okay, well, that's fine. Reporting also gives an opportunity for risk owners, business units, whatever, to tell their story. This is what we're doing. Here's why we're doing it. Here's the risks we are aware of, accepting those. And heavens, if something breaks, use that as learning. We broke this. Here's what we learned from it. The best organizations are learning organizations. And so use as opportunities for some transparency and honesty and say, hey, here's what we learned. Here's what we're going to do differently. And the final thing in this chapter is change management. And again, risk management is change management. We have to be able to manage change effectively. So really the key here is just using the same framework that we used for our enterprise and operational risk assessments, is looking at all of our major proposed change through the same lens of what's the design aspect, the strategy of it. Is it a good design? what are the operational aspects of it, and of all the implementation metrics and the ongoing operation. What are the things that could break, and then external influences. What on the outside world could affect this? It's the same 3 dimensions, using the same framework. And then the other key is really keeping people accountable to the idea of the benefit, the cost, and the risk. I've said this a million times. If we allow people to present ideas and they only present the benefit, you're not serious about risk management. They've got to be able to say, here's why we want to do this, the benefit. Here's how it will benefit us. Here's the cost in both hard and soft dollars. And here's the risk. Again, this is a cultural problem, because if I've got this great idea, the more I have to talk about all the spectacular ways this could go wrong, the more it impugns my great idea. But if we're going to be serious about risk management, we've got to be adult enough to be able to lay it all out there, the good, the bad, and the ugly, and say, we believe net that the risk is manageable and the value outweighs the risk, and therefore we should do it. So in the end, again, there's a lot there, and I hopefully there's some yardsticks to think about your program and think about where you might want to seek improvement. Really, sort of the undercurrent in all of this is that we've, to some extent, we've had some luxury, because I said it in the last video or last episode that up until now, risk management within financial services has been kind of straightforward because it's not that complicated. But our world is getting much more complicated with the infusion of new technology, digital, AI. Our whole world is going to get more complicated. It's going to get more competitive. It's going to move faster. And so we really need our programs to step up. We need to take our programs up another notch, because a good, strong risk management program helps us to be able to navigate that change and be able to get to kind of the next level. Okay, enough for practitioners. Again, I hope there's something useful in there I could use. I quickly thought for advisors. Again, consultants and other folks like me that are out there consulting, advising institutions or companies in general about risk management practices. There's a question that comes up is, say, well, is this still really a fertile space, because everybody's kind of built their programs? The answer is, it's never been more fertile. And there's never been more of a need for good, strong advisors that can really assist people, and for 2 reasons principally. Number one is, as I've kind of alluded to here today, is there's a lot of programs out there that are underbuilt. They're not performing the way they should. And there are opportunities for improvement. And you can very much be part of that equation, is saying, okay, let's take what you're doing and let's see if we can upscale it a bit and get it to a point where it's actually creating some value. That's number one. And number 2, again, with all of the changes coming, it's going to become more and more incumbent that these programs be right, because they will be part of how companies can navigate a much more complex world. And so there's going to be, I think, an increasing pressure and expectation on these programs to be part of the solution of how we do navigate into the future of whatever the future is. And I think this is where the advisor world can play an important role. What I would say is focus on program design and effectiveness and efficiency and all of that, not on content. Nobody's going to pay anybody for content anymore. Honestly, I can use ChatGPT to tell me what's the risk of X. I don't need you to tell me that. There may be some subtle nuances that you bring a particular expertise, but you're never going to monetize that. Monetize your ability to look at a program and say, we can help you make this better. We can help you create a program that creates more value. Thoughts for regulators. And again, I know a lot of regulators, and I appreciate you guys. I mean, look, you are also the conscience of the industry and very much part of the guardrails. And it's an industry that needs to have guardrails. And I think sometimes people forget that, the regulators, you really do want the institutions to succeed. But at the end of the day, you also need to be the adults in the room. I said this in the last episode, and I'm going to say it again if you'll forgive me, but you need to do a better job of evaluating risk management programs, both in terms of knowing what to look for, how to evaluate them, and then frankly, making the effort. I just seen too many times when, the exams were focused on all the ticking and tying of processes and controls and all that. And I've had institutions that said, I asked our, prudential regulator, do you want to see our ERM program? Like, yeah, no, we, what? I mean, God, this is the heart and soul of sound governance, of sound practices. And I can't imagine a scenario where you don't want to understand their thought process around risk management. So a couple of things, just some things to think about. And at some point, I think you need to strengthen your program about how you would look at a program, because this is different. This is not a controls checklist. This is a much more subjective conversation, because there's 100 different ways to do something. But I think there are some things you could be asking and looking at that would get to the heart of, is this program meaningful, or is it just a lot of busy work? Obviously, going back to the whole decision-making thing is to, show us evidence of how this program helps you make better decisions. Show us a decision you made that you can walk back to how the program helped you think that through. I think it's pretty simple, but it really is a litmus test of, does this program make a difference? Next, can you connect the dots and see synergy between your risk appetite framework and your risk philosophy, your strategy? I mean, do those look the same? Your risk assessments, are they telling the same story? The metrics, do they reflect limits that align with that risk appetite? How change is managed? Are you thinking about all those different lenses of the design, the execution, external aspects? So do these parts all make sense? Do they all have alignment? And is there synergy? Are they all telling the same story? Is there a clear three lines, and are those lines respected? Just manage to support those three lines. Even looking at the second line and looking at the CRO. And is the CRO trying to manage the risk, or expected to manage the risk? Or are they expected to architect a strong program and provide effective challenge? And are they providing effective challenge? Are they meeting with the board, talking with the board? What's the board told them their job is? Are in the program, are key risks identified, evaluated, discussed, or just innocuous ones? Does the program itself have a strategy, a roadmap, the risk program? Is there a plan for continuing to evolve it? Does the strategy articulate a future state? Who are we going to be in 5 years? That's a key part of risk management. Have the risks of the plan been identified? Do we understand the risks of what it is we're proposing we do? And again, this is not a controls conversation. This is a design conversation. This is our plan. This is our design. Time will tell whether it's a good design. Part of the risk management program is to be able to help evaluate, is this a good plan? And if it's not, how will we know? Now, look, I get it that regulators often have an audit background. They do like to look at things. You guys look at things according to some kind of a framework, a law, a regulation. But when it comes to enterprise risk management, there aren't really any good frameworks. All the ones out there, I think, are all highly flawed. You could certainly test against the ERM Advantage framework because, again, I've tried to focus on how we create value. But I think just because you don't have, a tick and tie box, it doesn't mean you shouldn't be looking at these things and really questioning, are they being effective? Again, is the program helping the company to be a better company? And, if you don't have a framework for evaluating programs, put one together. I'd be happy to talk to you about this. I think you could definitely do it where you could ask some good questions, because the reality is, if you guys push the industry to build better programs, it's good for the industry. That will do nothing but help the industry get better, is if you can be part of that prodding and asking some of those critical questions about, is what you're doing, does it make sense, or are there areas where you could improve? All right, let's kind of bring this in. I want to just talk about a couple of topical areas. We'll wrap this up. Got to talk about AI because, again, it's everywhere. I talked about this in the last episode and kind of broke down some of the three ways that AI can have an impact. Number one is knowledge management. Number two is generative AI. Number three is autonomous actions. At minimum, the knowledge piece is clearly going to be an element. I mean, both in terms of, analyzing, assessing external data, things like, transaction monitoring, things like that, as well as interpreting internal data, even things like risk assessments. This is going to be a very useful area. One of the things that AI is very good at is being able to observe large populations of data and look for subtle patterns. And risk management programs create a lot of data. That's just the reality, is they create a lot of data. So being able to use tools to help mine some of that and be able to get knowledge from it is a good thing. Certainly room for some generative AI. I think there's some clever things that we can see here. You say, hey, we're thinking about getting into XYZ loan product. What's the risk of doing that? And these AI tools have gotten incredibly good at being able to answer some of these questions. Now, obviously, we have to use with caution and evaluate whatever answers we get, but it comes to risk management. What's the risk of doing this? What's the most common way this goes wrong? You could learn an awful lot just by using some of these generative AI tools, and gives you a starting place to think about some things. And even the compliance world is, how do I comply with Reg X? That's a great place to start, and using your subject matter experts to kind of validate all that. I think a lot of this could ultimately impact, strategy, considering about, what would it look like to get into this product? How do people do that? What have been companies' success with that, or whatever? I think there's a lot of ways we can do a lot of what if using AI technology and helping to put more information on the table to think about. Machine learning certainly is going to be an important part of it, and will have increased influence. I'm not sure how much the acting like humans part is. We'll see. I know we're starting to see some of this in things like customer service, and I don't know, maybe in the end, talking with a really smart bot is better than talking with a call center person. Again, I've had good experiences with what I know was a bot, but it just knew everything I needed and got me to what I needed. And again, that is certainly better than the dreaded, press 1 for, press 2 for. So I think there could be some opportunity here, but this is kind of, we'll see. That's better, faster, cheaper. That's not revolutionary. Where things could be revolutionary is how we use AI to monitor things and be able to evaluate things and analyze things. One of the use cases that I am very intrigued with is, I think, being able to use AI to monitor things that are happening, and be able to put up red flags if patterns are observed that could be a concern, or somebody may want to pay attention to, whether opportunity or threat. Again, one of the things that AI can be very good at is seeing subtle patterns that could be the breath of wind that precedes the big gale, which precedes the storm, and something that people that are very busy may not notice. So I think there's some ways we could think about, how we use this, again, as a supplement to what we're already doing, but just in making us better. I think it's going to lead to opportunities to be able to look for new opportunities, to be able to do things better, how we manage things. But I think it is going to have a notable impact in how we can manage risk, and should be evaluated. The other topical point I want to talk about is the whole GRC world, mainly because this is an area that I have really mixed emotions about. From my perspective, and with all due respect to a lot of my colleagues out there that I know a lot of you, the perfect solution has not been built yet. I stand by that statement. Again, I think there's some good solutions out there, but I've been very, very transparent, and I think they're flawed in a number of important ways, not the least of which is so many are built on the flawed premise of dividing by the risk types. Once you start there, you're done. You're dead. Because the problem is the business doesn't work that way. Again, there's some solutions that I'm seeing that are kind of up and coming that are trying to be a lot more flexible, a lot more agile, and I think that they're very intriguing, and I think they appreciate the fact that they need to align with how the business works, and that's smart. But again, I think there's a lot of ways for solutions to improve and advance, and these will get better. But what I will say is this. I think one of the bigger problems that I've seen is companies that jump too fast to implement a solution. Said, well, we've got a mess of a program and we've got data all over the place, so we're going to get a technology and that will bring structure. No, that's akin to, well, our marriage is a mess, so let's have another kid. We all know how that movie ends, okay? Putting in a technology is never going to fix flawed process. It's never going to fix the lack of a framework. It's never going to fix the lack of structure. It's only going to make those worse. So please, I'm begging, get your process down first. Figure out what it is you're trying to do and solve. Get a decent process around appetite and risk assessments and metrics and reporting, done in desktop tools. And again, I mean, to be direct, I offer all these tools, but they're available, they're designed well, they work, and they're very, very affordable. And get a program that works and is getting you information that you can help to run your business, and then figure out the best tool to automate your process. It's the one thing that I could say is a make or break from what I've seen, and the trash heap of solutions that they tried to implement and it never worked is huge. So please consider that. Now, I'm not going to go deeper down this path because I've got a colleague of mine who's a deep expert in GRC coming on in a couple of weeks. I'm very excited for that conversation where we're going to unpack this much further and some do's and don'ts and best practices and lessons learned and all that. All right, let's just talk a little bit about the future state, and that'll wrap things up, and just a little bit of sort of what I would like to see. If I was going to describe a strong future state for an enterprise risk management program, kind of paint what I think that future state needs to look like. It's a program that challenges leadership, but also supports them. It creates a structure for challenging why are we doing what we're doing, but also helping in the process of making those decisions. As well as evaluating, what we're doing in our execution and does it make sense? Are we taking the right risks? Creating a culture that has transparency and honesty and accountability, that people are willing to say, yeah, I broke that. That was on me. I didn't understand that, or we didn't understand the risk. Or be able to say, we want to do this and it's got a huge risk, but here's why we think that's okay. Here's why we think we should do it. Or this has a risk and we're not going to mitigate it further because we know what the risk is. Risk leadership that has a seat at the table is part of the strategy conversation. That's part of ongoing discussions around decision making and can serve, again, as a voice of challenge, a subject matter expert, but is seen as a leadership equal, not as internal audit too. A program that is focused on the stuff that matters and not majoring in the minors. If I see another risk register that has 300 risks on it, all the way down to cuts and scrapes, it just drives me nuts. Focus on the stuff that matters. Otherwise, you're wasting a lot of people's time, and is constantly turning over new rocks, saying, what is it we don't know? What haven't we thought about? And that is something that would really make a difference, because now we're not just documenting what we know, we're seeking new knowledge that makes us better. And then the subset of that, operational risk management, operational risk program, again, focuses on the things that matter, core processes, key risks, the conclusions about those. What is my residual risk, and is it okay? What are my exposures? And being able to make informed decisions about how we do what we do, so that we keep the process as frictionless as possible and we use our resources as efficiently as possible. And on a day-to-day basis, it's part of the fabric of what we do, not a bolt-on to what we do, in helping to create awareness, accountability, and actionability. So if things do go sideways, we can respond quickly. So that's just some things that I think would be evidence of a really strong program where I'd like to see us get to. The bottom line is our world is getting more complex. We no longer have the luxury of programs that are just, nothing but busy work and documentation exercises and the appearance of risk management. They need to actually challenge us and help us make better decisions. Now, again, I've got a whole series of guests coming up that I'm really excited about. These are practitioners, former regulators, consultants, a wide spectrum of people with different expertise, and I'm going to ask them to challenge my observations, add on to them, give their own perspective, and let's learn and grow on this together. So for now, thanks for listening.
The ERM Advantage podcast is recorded at Lightshed Studios, Philadelphia, Pennsylvania. Copyright 2026 ERM Advantage LLC, all rights reserved. To inquire about appearing on the podcast, please contact us at ermadvantage@gmail.com.